All right, in this video, we want to look at two things. So we'll look at two distinct things. So we want to look at the concept of correlation, and confluences. So we'll focus on these two things. So for now, let's dive into what correlations are. But before you can understand correlations, you need to understand something else. Now, that thing you're supposed to understand is the dxy. So now the dxy is simply a basket of currencies, compared to the dollar. By dollar, I actually mean the US dollar. Let's see. This US dollar. So the DXY is a basket of currencies compared to the US dollar. Now, why is this important to know? Because the DXY represents the US economy. So whenever you see DXY, just know that it's a collection of currencies compared to the dollar. Or in other words, it's an index showing us how the US economy is doing. With that in mind, we're going to have a refresher now, let's see. We're going to go back to something we did, I think, in one of my videos, base and core currencies. In one of my videos, I think it was on fundamentals, I explained this concept of quotes and base currencies in details. But for the sake of this video, let me just explain what a base and what a quote is, just for the sake of this video. So if you have the USD CHF as your pair, USD CHF, oh yeah, that's then our F right around there. So you have USD CHF. It means that the first currency in a given pair is your what? Your base. The second one is your quote. So this is our base, the first currency in a given pair, which in this case is the USD, this one. Then the CHF is our quote currency. Now the importance of this, I'll go back to the DXY. So the DXY is an index that shows the strength of the dollar. In other words, if the DXY is going to the upside or it's moving in an uptrend, we expect any pair that has the US dollar as the base. So that means US dollar is the base. Examples would be the same one we have, USD CHF, and another example would be USD JPY. Let me just type that here. So you can have USD JPY. That's another example, USD JPY. So as long as the US dollar is the first currency that you're able to see in any given pair, it's the first one, it will be moving in the same direction as the DXY. That means the US dollar is the base currency. Base currency just means the first currency in a given pair. So like in this pair, USD is the base, then the quote currency is CHF. So that means if our DXY is moving to the upside, we expect this currency pair as a collective to be moving to the upside as well. Let me remove that. Hope that made sense. Let me do this. Okay. If this is our DXY, clearly it's moving in an uptrend like that. Then, so I'll just put it here, DXY. We expect anything that has the dollar as a base. Dollar as a base just means the dollar is the first currency that you're able to see in any given pair. So I can just say USD, USDZA. R, that's US dollar with the South African rand. You can say USD, JPY, USD with the Japanese yen. I'm sure you get the idea. Anything that has US dollar as the base. So USD CHF, USD CHF like that. Anything that has USD as the base, or USD is like the first currency that you're able to see, will also be moving upwards. So in other words, we can come up with a relationship here. So between that and this, what type of relationship exists? So you will notice that the type of relationship which is existing here is known as a positive correlation. Now, a positive correlation just means two things are moving in the same direction. If we had this going up, we expect this to also be going up. This was going down, this will also be going down. So let me remove that. If we had downtrends for this, a downtrend like that, then here we also had, what type of trend was going to exist here? If you say uptrend, it means you have to go back and watch this video again. It's supposed to be downtrend because remember we've said these two have a positive correlation. Any currency pair that has USD as a base and whatever currency that follows here doesn't really matter. As long as USD is the base, it will move in the same direction as the DXY. So now let's look at now practical examples of this. Let me just remove that. So we've seen here we have USD CHF. So this we're expecting it to be moving in the same direction as the US dollar. So let's go to our DXY. So this is the 5 minutes time frame. And we can see generally we had this massive drop all the way to that level. Then there was some kind of pullback to this level, but the momentum to the downside was strong. So you can see this market pushing all the way to those lows there. Now, based on what I've explained, since the DXY is going down, what do we expect to be happening to USD CHF? So I'll give you a minute to answer that. And the time is up. We're expecting it to also be going down. You can see here, this is not the same chart. You can see from here, USD CHF. So it also follows the same pattern. It had this massive drop. Then we can see some form of a pullback from that level, pushing upwards. Then we had this massive drop. Now someone might ask, what's the significance of what we are doing now? This means you already have an advantage over the markets. What you do is go back to my lesson on support and resistance. You know why I'm drawing these as my support levels. It was a resistance level here, which has now turned to support. And also have this level as well. that level there. So now, if I was trading this, let's say I've missed this move, this massive drop, because I was expecting the market to be going up, but we see that's not what happened. Then it broke past that level. It comes back for a pullback, this mini pullback here. Then before I can enter for my short here, trying to catch this move, trying to catch this move now to the downside, this move here, all the way to that level. How do I do it? I just check where is the DXY going. And I can see that it had this massive drop, and from these levels, it's forming some sort of, let's see from that. I'm sure at some point we obviously had, let me just push this to the right. Let's see. Settings, extend to left. Okay, so I can see we most likely had some important, okay, yeah, we can see from this level here, even here, there was that mini push. So that's the significance of this level. Once the market goes back to this, I'm expecting for it to do what? To drop. Now this has given me an additional confirmation to say that this market is going to be going downwards. Hence, I'm only looking for a short for USD CHF. Why? Because it moves in the same direction as the DXY. So that tells me that if the DXY is going down, most likely, not even most likely, I know for a fact that USD CHF has to also be going down. Hence, I get my confirmation. Confirmations are just what gives you confidence in your trade or your bias. So for me, the DXY here has given me confirmation. Hence, I'll just wait for a candlestick pattern that shows me bearish momentum from this level. I can see there was a weak rejection. Okay, now let me just remove that arrow. Yeah. You can see if I was to draw a circle here, you notice that there was a weak rejection. There's that weak rejection. Then a bearish candle appears. So weak rejection forming some sort of a gravestone doji. I'll create a video on candlestick patterns. So now that gives me confirmation. You can also think of this as an evening star. An evening star that is a bearish candlestick pattern. Hence, once I see that, I put my stop loss somewhere right above those levels. So my stop loss would be somewhere above. You can see these wicks here. You can see they're like some wicks right around this level. So you want to put your stop loss right above those wicks, somewhere there, because you know the momentum is high. How? Because of these strong bearish candles that followed each other here. Hence, you know that it's unlikely that the market will push back all the way up, passing these weeks to stop you out as it goes to the downside. So there you go. You make your money like that. Hope this helps. The last thing is, what if, let me write this here. I was talking about base. I was talking about base and court currencies. Court currencies. Now, what if the USD is not your base? So I'm talking about currencies like Euro USD. Okay, here, let's see. Australian dollar with the US dollar. We're talking about Euro USD. We're talking about NZD, New Zealand dollar against the US dollar. An example of this. Remember, we said whenever the US dollar is the base, when the US dollar is the base currency, it moves in the same direction as the DXY. Now, with this in mind, with that in mind, my question is, where do you think these currencies have written down here are going to be going? If when the US dollar is the base, the currencies such as USD CHF, now this will take time, I'll just write it here. So I have currencies like this, USD, JPY, USD, I don't even know if USD New Zealand dollar is there. USD ZRA, then USD CHF. Isn't right? Here the US dollar is a base. It's the first currency in all these pairs. You can see it's the first currency. It's the first currency. It's the first currency. It's the first currency. Now, whenever US dollar is the first currency like that, we say these will be moving in the same direction as the DXY. Now, what if when the US dollar is not the first currency? You can see here we have the Australian dollar, yes, the euro, there's the New Zealand dollar. So these will be moving in the opposite direction. What that means is if the DXY is moving upwards like this, that's your DXY pushing to the upside. You expect any of these currencies to be moving to the downside. Does that make sense? So that means the relationship between when the US dollar is a quote currency, remember quote currency just means the US dollar is the second pair. By the way, this DXY only applies to currencies that have the US dollar in them, like that. You've seen this, right? So this means these will have a negative correlation with the DXY. Negative correlation. That means they'll be moving in opposite directions. You can see that. Now, before I continue and bring out my other point, it's good to note that whenever the US dollar is a base just means it's the first currency in a given pair, it will move in the same direction as the DXY. But whenever the US dollar is the second currency, that means it's a quote currency, then it will be moving in the opposite direction as the DXY. Now here's a short quiz for you. What would be the relationship between Australian dollar with the US dollar compared to USD JPY? I'll give you 1 minute to think about that. Or even, what would be the relationship between this and, I can even add another currency here that I had left out, and it's even a major currency. USD. No. What am I doing? No. It's actually supposed to be here. Let me see. It's supposed to be here. Okay. USD GBP. It's actually GBP USD. Yeah. I don't know why I'm confusing myself. Okay. So this, what would be the relationship between any of these with these currencies on top? You notice that if we've said these always move in the same direction as the DXY, that means if the DXY is moving up, all these pairs I've written down here are supposed to be moving up as well. But then, if these ones will be moving up, it means everything here is going to be moving down. If you didn't think of them moving down, you need to watch this video again so that you get the concept. So then that also means that what type of relationship exists between these currencies here is that they have a positive correlation. In short, they always move in the same direction. And that only makes sense because they all have the USD as their base currency. And then these ones here, you can say Euro USD, this one, with that, GBP USD. These ones also have a positive correlation. All these currencies here have a positive, negative positive correlation to each other. Why? Because these ones always move in the opposite direction as the DXY. Now, what really matters is the strength of that correlation. Remember, correlation can be termed as a very, very strong or high correlation, medium, and low. So for some, it's very low. But the ones which have the highest correlation, we have Euro USD and GBP USD. We also have a negative correlation between USD and GBP, which is very significant. So GBP and these two, they're the negative strong correlation. So you have this having a strong correlation with that, Euro USD and GBP USD. We also have GBP USD with USD JPY having a strong negative correlation. So that's the idea. So now let me remove everything here. So with that said, let's go back to our previous example. In this case, you've noted that we have already realized that our DXY was moving in a downtrend. So we're waiting for it to reach that level. Once it gave us a signal here, we're not going to sell because personally I don't trade the DXY. I just use it for confirmation. Here I can see it formed some form of a bearish engulfing candle. So I know that it's headed to the downside. Then my bias for any currency pair that has USD as a quote is to be going to the upside. So you can see, if I was to zoom out, you can see that it's kind of like the opposite chart. We had this strong impulsive move to the upside. seen, right? So meaning I would have put my, I don't like this being extended to the left. We'll just leave it at that. Yeah, like that. So I would have put my key level as in this, I mark out this zone. I wait for the market to tap to this zone. Once it does, I'll be watching what will be happening with the DXY. I can see that here we had that strong push to the downside. Once I see this confirmation here to sell for the DXY, then I go back to, what was I looking at? Our DSD. I come to this level. I see that we have these four, what kind of stick pattern is this? It's a Harami pattern. Harami pattern. So this is a strong signal for buying or going long for the market. And since I can see there was a strong drop, I'll obviously put my first TP right around these levels. Then my next one will be the same size or the same distance, which is the distance I'm talking about is this. How am I coming up with it? Because we had a strong drop, hence I expect a similar move to the upside. So my TP would be somewhere, I can put it on this key level there. Then once I see the market meandering here, what I'll do is I'll just exit the market because it means it has lost the steam once it starts consolidating like that. So that's how you can use the DXY to trade any currency pair that has gold with it. Sorry, that has the US dollar with it. Talking about gold, what do you guys think would be the relationship between gold and the DXY? So gold, let me just do this here. Gold is this, it's XAU USD, right? So we can see that gold has the US dollar in it. That's the first part established. The next one is gold or is the US dollar the base or the quote? So you can establish that it's the quote because it's the second currency. Next question you ask yourself, what is the relationship between whenever the US dollar is a quote and the DXY? Remember, when it's the base, whenever it's the first currency in a given pair, it's called the base. Once it's the base, we expect the relationship to be positive. In short, they're supposed to be moving in the same direction. If it's going up, they're all supposed to be going up. If it's going down, they're both supposed to be going down. But in this case, since it's the quote, it's not the base. It's the quote currency. So what we expect is it to be moving in the opposite direction as the DXY. So we can just prove that. So the US dollar, sorry, the DXY and gold move in opposite directions. Let's just prove that. So we have the DXY here moving to the downside. Then there was that strong push up. Then you can see currently it's like dropping to the downside. So we expect gold to be moving up. Why? Because it has a negative correlation to the DXY. So you can see. So you analyze the DXY like you're about to trade it. And then the direction that you form your bias towards, just trade the opposite when you come to gold. So you can see there's this consolidation happening here. There's some kind of consolidation. But overall, we can see that gold was pushing to the upside. So you can use the DXY now to be your confirmation. Hope this helps. And then I talked about, let's see, before I end this video, I talked about two things that we are supposed to look at in this video. So we've looked at we've looked at confluences and correlations. So now confluences are just having a lot of, how do I explain it in a more easier, what I'm thinking of saying wouldn't really be something that people would get. So let me just do this. I'm sure this is going to help more. Okay, so what we mean when we say confluences, you just have a lot of indicators. By indicators, I just mean things that you are looking out for have converged at one specific point. For instance, if my bias is that this market is trending to the upside, then I want to take a trade right around here. You notice that that same level was the previous resistance that has become support. Again, that same level is probably going to be part of our fib levels. You can see it's in that gold zone. It's somewhere here within this gold zone. The next thing you notice is if I was to zoom in, there'll be candlestick confirmations that I'll be waiting for. Now, all those things that I'm finding are called confluences or factors that are supporting my bias. The next thing would be, since this is good, right? If I was to check the DXY and it was dropping, it means it has also given me a further confluence to trade. That's what confluences are. Correlations are just the relationship between two things. So we can say that the relationship between gold and DXY is a negative relationship, meaning they move in opposite directions. Then anything that has USD as a base moves in the same direction as the DXY. Anything that has the US dollar as a quote moves in the opposite direction as the DXY. Hope that helps. I don't want to make this video long. If you have questions, leave them in the comment section. Don't forget to like, subscribe, and share with your friends. I'll see you in the next video.